Right. Let's unpack this. We're diving deep into the month that it was June 2025. This is from the Macro Butler.
Right.
Now, if you're anything like us, you're just constantly swimming in headlines, data points, all that market chatter.
It's a lot. Information overload is real.
Totally. And it's tough, to cut through it all and figure out what really matters for your investments.
Mm-hmm.
So that's basically our mission today. We want to give you a fast track to being, well, truly well-informed about what's really moving the market.
Pulling out those crucial nuggets.
Exactly. Extracting those nuggets you need to know. What's genuinely going on beneath those flashy headlines.
Yeah, and our goal, it's not just about telling you what happened in June 2025, macro-wise.
Right.
We really want to connect those dots for you, sure why these shifts matter for, your actual investment decisions.
Help see the bigger picture.
Exactly. Help you see that bigger picture so you can navigate these, well, let's face it, pretty complex waters with a much clearer view.
Okay, good. So let's jump right in. The Macro Butler called something the labor market mirage.
Ah, yes, the mirage.
Because, on the surface, May's jobs report looked hotter than expected, didn't it?
It did initially. Headline payrolls were up.
And sectors like leisure, hospitality, trade, they didn't completely fall off a cliff like some people feared.
No, they held up better than expected on the surface.
But then you look under the hood, as they say. What did it really reveal?
Well, it's truly a classic mirage, because despite those sort of upbeat headlines, the underlying data much shakier.
How so?
We saw household employment actually fall. The labor force itself shrank.
Oh, wow.
And maybe most telling past months' data points, they got revised down.
The revisions. Always got to watch those.
Always. So what this signals for you, the investor, is that the strength we thought we were seeing, it was maybe more of an optical illusion.
Suggesting some underlying weakness, then.
A profound underlying weakness, yeah. Despite the surface appearances, it's not just a statistical blip, it feels more like a foundational shift happening.
And it wasn't just the big picture numbers, was it? Like drilling down.
Exactly.
Average hourly earnings, they rose, but only modestly, right? 0.3%. That was actually below expectation.
Below expectations. And average weekly hours worked, stuck, unchanged at 34.3.
Which tells you something about real purchasing power, I guess.
It does. And this raises a really crucial question for the everyday economic picture. What does this mean for stability?
Okay.
So the unemployment rate, yeah, it stayed at 4.2%, which, on its own might not sound too alarming.
Right. It seems okay in isolation.
But here's where it gets really interesting and maybe a bit concerning. It's been above its 2-year average since way back in September 2023.
Okay, that's quite a stretch of time.
It is. And historically, every single time this has happened, when the unemployment rate crosses and just stays above its 2-year moving average, it is strongly suggested that, well, broader economic clouds could gather.
Over what time frame usually?
Typically over the next 12 to 24 months. It's subtle, maybe, but it's an incredibly significant leading indicator of potential economic deceleration.
That certainly gives us pause. Okay, let's pivot a bit. From the labor market to consumer spending.
The backbone.
Yeah, we always hear that consumer spending is the backbone of the economy. So what did June's retail sales numbers tell us about the health of that backbone?
Well, the May report, it showed retail sales fell 0.9%.
Fell, okay.
Yeah. And this was specifically driven by declines in, the big ticket items.
What?
Autos, gas, building materials, precisely the stuff most exposed to tariffs, and let's be honest, rising price fatigue from consumers. People are just getting tired of high prices.
Makes sense. But there were some bright spots.
Oh, well, bright spots might be generous. What's fascinating is while those big purchases fell, we did see modest gains in categories like furniture, sporting goods, and online sales.
Okay, so what does that tell us?
It's not just random noise, right?
Yeah.
It suggests consumers are becoming much more selective. Maybe shifting towards essentials, maybe smaller comforts instead of the big splurges.
Right.
The trend seems clear. Spending is becoming incredibly price sensitive, which means, the average household budget is under real pressure.
So, connecting this back, while retail sales might seem resilient if you just glance at the headlines, there's a really vital distinction here, isn't there? They're nominal figures.
Exactly. They don't account for inflation.
Which is huge.
It's critical for investors. When we adjust these retail sales for price increases, look at the real numbers. We're actually still below the peak from way back in April 2022.
Wow, still below that peak.
And May was barely above last September. So immediately begs the question, what's the historical significance of that pattern?
Okay, lay it on us.
Historically, peaks in real retail sales. So the actual volume of stuff people are buying, not just the dollar amount. They often coincide with tops in the S&P 500 to oil ratio.
The S&P to oil ratio. Explain that a bit.
It's basically an indicator of equity market strength relative to a core commodity, oil. And it has this uncanny track record.
Okay.
When that ratio tops out, and then it precedes a slide below its 7-year average, well, it acts as an almost prescient leading indicator that the broader market is likely set for a significant correction.
So, bottom line.
In short, recession risks are truly rising, even if Wall Street isn't quite ready to admit it yet.
That's a strong warning. And one that, yeah, maybe many on Wall Street are choosing to ignore for now.
Seems that way sometimes.
And if we're talking about overlooked realities, we have to talk about inflation, that persistent, almost mythical 2% target we seem to be forever chasing.
The Fed's fantasy, as the Macro Butler puts it.
Exactly, the Fed's fantasy. So what's the latest verdict? Are we getting closer to that 2% goal?
Well, MAGA CPI kind of confirmed that March's little dip into deflation, that was a short-lived anomaly.
Just a blip.
Just a blip. Tariff-driven price pressures are clearly back. And someone, whether it's consumers or producers, someone has to foot that bill.
So savvy investors shouldn't be holding their breath for 2%.
I wouldn't say so. They aren't buying the 2% inflation fairy tale, and honestly, for good reason.
Why is that?
Well, look around. With global tariffs popping up again, ongoing geopolitical conflicts, the reality is that price pressures are just going to prove far more persistent than any, neat econometric models on Wall Street care to admit.
The world's just more complex now.
It's becoming more fragmented, supply chains are still kind of messy, and all of that just builds in cost. It makes things more expensive.
At the actual math behind hitting that 2% target, it's pretty daunting, isn't it?
It's staggering. I mean, to actually reach 2% by the end of 2025, CPI would need to basically tiptoe in at under 0.1% monthly.
Which is like...
basically a statistical unicorn. It doesn't really happen.
Right. And what if it's higher? Like 0.2% monthly?
Which frankly seems way more likely given everything. If monthly prints just creep up to 0.2% or more, we're looking at year-end CPI anywhere between 2.6% and potentially a staggering 5.5%.
Wow, that's a huge range. Very different outcome.
Exactly. Which is precisely why we probably need a broader measure to really understand the true price pressures out there.
Like what?
Well, for example, the U.S. Umbrella Inflation Index that the Macro Butler tracks. It gives a much more comprehensive view.
How does it do that?
It averages a bunch of things: CPI, core CPI, PPI, core PPI, core PCE, and even one-year consumer inflation expectations.
So it smooths things out.
Exactly. This blended approach makes it much harder for, one quirky data point to obscure the real underlying trend. And what this index tells us, inflation isn't magically disappearing. Not by a long shot.
This brings us to another really powerful concept from the report. Rising chaos equals rising misery.
Yeah, that's a stark way to put it, but it connects.
What's the relationship there? We've seen inflation isn't just simple supply and demand anymore. It's fueled by, like, 3 core forces.
Right. Supply shortages, sure. Excess demand, okay. But crucially, a breakdown in trust. And all of those things, they thrive when there's policy uncertainty. Chaos, basically.
And how does that ripple effect work?
Well, what's truly fascinating here is the ripple effect. When consumers, when investors, when businesses start to lose confidence in the government's direction.
Or maybe question if there even is a coherent direction.
Precisely. Then expectations become unanchored. People don't know what to expect, so inflation can accelerate just based on that uncertainty.
And this isn't just theoretical.
No, not at all. The real-world consequence is that rising policy dysfunction, this sort of chaos, it doesn't just lead to rising CPI. It also leads to rising misery.
And how do we measure that?
We measure this with the misery index. It's a simple calculation. Just the CPI year-over-year to change added to the unemployment rate.
Inflation plus unemployment.
Yeah. It's a potent and, frankly, pretty painful combination for the average person, and definitely for overall economic stability.
That is a stark picture. Okay, let's talk about the central bank, the Fed, what the Macro Butler calls the eyes wide shut FA.
Yeah. That's provocative.
So what was the Fed's stance in June 2025? Predictably, I guess. They held rates steady again, right? 4.25 to 4.5%.
4th straight meeting. They're maintaining that wait-and-see stance, especially with all the rising geopolitical and trade risks swirling around.
But what about their projections? What are they telling us?
Well, if you connect this to the bigger picture, their latest projections, They actually hint quite strongly at stagflation.
Really? How so?
They cut their 2025 growth forecast down to just 1.4%. They revised core inflation up to 3.1%, and they expect unemployment to rise.
Growth down, inflation up, unemployment up.
Yeah,
Sounds stagflationary.
it does. Yet somehow they still cling to this confident forecast of inflation magically easing back down to 2.1% by 2027.
Which seems optimistic.
It seems increasingly disconnected from the current economic realities we're actually seeing. It's almost like they're looking at a different economy than the one the rest of us are living in.
And their latest dot plot, the chart showing where officials expect rates to go.
Still clinging to its fairy tale of 2 rate cuts in 2025, unchanged from March.
So, hope springs eternal at the Fed.
It's a stark reminder, isn't it, that in central banking, hope sometimes remains a primary policy tool.
But the big question lots of investors are asking is, are there really still no reasons to cut rates in 2025? I mean, with growth slowing.
Well, this immediately begs the question, why the disconnect? Why the disconnect between their forecasts and the actual data coming in?
Yeah.
If you apply something like the Taylor rule, which is a widely used guideline for setting interest rates based on inflation and economic slack,
Right.
using the current data we have, like core PCE at 2.5% and unemployment at 4.20%, the Taylor rule suggests the Fed funds rate should be closer to 5.58%.
Wow, significantly higher than the current 4.50% ceiling.
Exactly. So while the markets, they're still kind of pricing in or expecting Q4 cuts,
Hopeful thinking, maybe?
the reality might be far less comforting. As the U.S. economy potentially shifts from this inflationary boom phase into more of an inflationary bust.
Stagflation again?
Yeah, the Fed could actually be forced to raise rates instead of cutting them, which would be a major, major surprise for a lot of people.
That would definitely send ripples through the markets. Okay, let's look at another, maybe slightly more obscure but intriguing development. The quiet return of the Fed's invisible hand. Liquidity. What's happening there?
Yeah, this is important. After nearly a year of liquidity tightening, QT,
Quantitative tightening, right. Shrinking the balance sheet.
we're now seeing what's called shadow liquidity expanding again.
Shadow liquidity. Explain that.
It happens as the Treasury draws down its TGA, that's the Treasury General Account, basically the government's checking account at the Fed.
Oh.
As they spend that money down, especially ahead of the debt ceiling deadline, that action effectively injects cash back into the financial system. It loosens conditions a bit, even while the Fed is officially tightening.
So like an offset to QT.
In a way, yeah. And what's truly fascinating here is the tightrope the Fed is walking.
How so?
Well, there's only about $333 billion left in that TGA and maybe $168 billion in the RRP, the reverse repo program, where banks park excess cash.
So those cushions are getting smaller.
Exactly. Which means the Fed might soon be forced to actually halt quantitative tightening, stop QT, just to maintain basic market liquidity and prevent things from seizing up.
Wow. So QT might end sooner than expected.
It's possible. And what this means for you, the investor, is that rising volatility market choppiness significantly increases the likelihood of a liquidity Fed put being triggered.
The Fed put, the idea the Fed will always step in to save markets.
Essentially, yeah.
Yeah.
An intervention to stabilize conditions by injecting more liquidity, and it becomes increasingly likely as market stresses start to mount.
Okay, so how does all this complex stuff, the labor market, inflation, Fed policy, liquidity, how does it actually trickle down to corporate America and, most importantly, to your portfolio?
Good question. Let's talk about the misery margin squeeze.
Misery margin squeeze. Sounds painful.
It often is for companies.
Yep.
Rising levels of economic misery, which we defined as that combo of accelerating inflation and higher unemployment.
Right.
Historically, that combination has consistently signaled a deterioration in corporate operating margins. It just gets harder for businesses to make money.
Which naturally pressures profits.
Exerts downward pressure on profitability for almost all businesses, yeah.
So the investment takeaway is?
The investment takeaway here is exceptionally clear based on history. In an environment like that, investors really must consider selling the rips in equity market rallies.
Sell the bounces.
Sell the bounces, because declining margins typically translate directly into weaker equity returns across the board. It's generally not the time to be chasing every little upward move.
Okay. And what about oil prices? The Macro Butler makes a direct connection. When oil rises, so does misery.
Yeah, it's often true. Rising oil prices, especially if they're driven by supply disruptions, think geopolitical shocks, wars.
Right. Things happening now.
Those are inherently stagflationary. They raise costs for literally everyone, but they don't necessarily stimulate growth. It's just a cost increase.
So how does an investor play that?
Well, for investors, this actually provides some actionable insights. In an environment marked by rising economic misery, historical data shows a pretty clear pattern.
Which is?
Large cap value stocks, think like the Dow Jones constituents, they tend to significantly outperform small cap growth equities, like you find in the NASDAQ 100.
Value over growth in that scenario.
Generally, yes. And at the sector level, it becomes about picking sides, really. Energy producers tend to do well because they benefit from those higher prices. But energy consumers, companies that use a lot of energy, they get hit by higher input costs, and they tend to underperform. So it's about knowing where to place your bets when those economic winds really shift.
Got it. Okay, finally, let's talk about what many consider the ultimate safe haven, especially in uncertain times. Gold. The report says, when misery rises, only gold stands tall.
It has that reputation for sure.
Why is that, especially in stagflation? We mentioned stagflation drives long-dated bond yields higher, right,
Yeah.
because of risk premiums.
Exactly. So bonds aren't necessarily the safe haven people sometimes think they are in that environment. In such a uniquely challenging environment, rising inflation, rising unemployment, gold really does stand out historically as perhaps the only reliable store of value.
It holds its ground.
It has a proven track record of preserving wealth while other traditional assets, including potentially long bonds, can falter. This
Yeah.
isn't just, an anecdote. It's a pretty consistent historical pattern.
And building on that, the Macro Butler gets even more provocative. In chaos, we trust. With gold, we survive.
Strong words.
What makes gold so uniquely special right now, particularly with all this talk of uncertainty, trade tensions, geopolitics?
Well, think about it. U.S. tariff flip-flops, escalating global tensions.
Yeah.
All this stuff fuels immense market uncertainty. It erodes trust, not just in markets, but maybe even in institutions.
And highlights counterparty risk.
Exactly. That's the risk, that the person or entity on the other side of your transaction might not fulfill their obligation. As that confidence wanes in traditional financial instruments and governmental stability,
People look for alternatives.
seasoned investors are making a clear rotation. They're moving into the one asset that, crucially, needs no signature, no government bailout, no central bank intervention. And that's physical gold.
It's independent.
Totally independent. Gold doesn't flinch at trade tantrums or political paralysis or scary headlines. In fact, you could argue it almost feeds on chaos.
So for gold, uncertainty isn't a risk.
Uncertainty is more like a catalyst for its upward movement. It's the ultimate independent asset in that sense.
Okay, so pulling all these threads together, where does this leave us? The report says the U.S. is still technically in an inflationary boom, but the big question is, for how long?
Right. As of, say, June 20th, 2025, the U.S. is still technically in that inflationary boom quadrant. It's been there since May 2023.
And in that environment, the typical advice has
The
been,
conventional wisdom, has been for investors to predominantly own equities and gold, kind of a barbell.
okay, but I sense a but coming.
There's a critical warning here. The S&P 500 gold ratio, which again is a really powerful long-term indicator of equity performance versus this safe haven asset.
Yeah.
It has broken below its 7-year moving average. That happened back around the end of January.
And why is that specific ratio and that moving average so important? What's the historical precedent?
Investors should really note this. Every single time this ratio is broken below its 7-year moving average, it has never been a good omen for markets.
Never. That's strong.
Never. We saw this pattern play out in the early 1970s, before that stagflationary decade really hit. We saw it again in the early 2000s, before the dot-com bust aftermath, and most recently, January 2020, right before the pandemic shock truly hit the markets.
Wow. Okay, that's a pattern you don't want to ignore.
It's not a correlation to ignore now.
And it gets even more concerning.
Potentially, yeah. Because such a breakdown in the S&P 500 gold ratio, historically, it has often preceded the breakdown of another key ratio, the S&P 500 oil price ratio, usually by a few months.
And when that ratio breaks down,
That breakdown has also never been a good omen. Not for financial markets and not for the broader economy, usually signaling that the economy is moving from a boom into an economic bust phase. These are really powerful historical signals, flashing yellow, maybe even red.
okay. So what's next for financial markets then? How should we be thinking?
Well, the latest economic data, as we've discussed, it continues to show the U.S. economy weakening. Consumer spending is softening, unemployment is ticking up. This all feels like it's associated with what we might call an inevitable reflation slow burn.
Inflation stays sticky while growth slows down.
Pretty much. And those stagflationary forces are very much in play.
Tariffs, wars.
Tariffs and wars, as the Macro Butler says. They are historically stagflationary. They increase prices, they dent consumer confidence, and they hinder overall economic growth. It's kind of a lose-lose situation for the economy.
So that 2% inflation target.
Forget about it being a ceiling. It's fast becoming the new floor, especially in this more multipolar world with all these rising inflationary tailwinds, deep globalization, demographics, decarbonization, defense spending.
Lots of structural pressures pushing prices up.
Exactly. And in that kind of context, long-dated bond yields will likely rise to new decade highs, unless the Fed does something really drastic, like yield curve control, which seems unlikely right now.
So bonds might not be the place to hide?
Probably not long-dated ones. And the unfortunate reality is, after cutting rates back in the 2024 inflationary boom, which kind of implicitly gave up on their inflation mandate for a bit,
Yeah.
the Fed has, in a sense, sort of painted itself into the high end of the inflation fork. And what that means for those of us just trying to grow our wealth.
For passive investors especially.
For passive investors, yeah, it means the 2020s are increasingly likely to resemble the 1970s, a lost decade, in real terms, potentially.
Wow.
This isn't just about struggling to keep up with inflation. It's about potentially seeing your purchasing power actively erode year after year if you're not actively managing your portfolio for this environment.
And adding to that, you mentioned shadow liquidity is tightening now.
Yeah, those injections that quietly fueled some market exuberance, they're tightening. And historically, that tightening has often been a leading indicator of looming banking stress or even crises.
Okay, more risk on the horizon.
It just means the risks of the U.S. economy shifting from this boom phase to more of a bust phase within, say, the next 6 to 9 months. Those risks are significantly increasing.
Okay, so given all this, it's a complex picture, a bit worrying. What are the absolute key takeaways? What should investors be doing with their strategy right now?
Okay, let's boil it down.
Yeah.
Crucial advice based on these patterns. Once that S&P 500 oil ratio finally drops below its 7-year moving average,
Which could be coming soon.
could be, at that point, every single equity rally becomes a selling opportunity. You need to be disciplined.
To sell the rips.
Sell the rips. And decisively shift your focus. Think about buying the dips in energy producers while simultaneously selling strength in energy consumers. Be strategic about sector allocation.
What about individual company quality?
Absolutely critical now. The focus has to remain squarely on quality companies.
Meaning?
Look for businesses characterized by low financial leverage, not too much debt, minimal refinancing risk, they don't have a huge amount of debt coming due soon, and consistently high return on equity, ROE.
Why those factors?
Because those are generally the companies best able to grow their earnings per share, grow their free cash flow, even above the rate of inflation. That makes them resilient in this kind of challenging environment.
And assets to hold, besides energy producers.
As we discussed, physical gold and silver should absolutely be the appropriate core asset allocation to navigate the upcoming inflationary bust, that stagflation scenario. History is pretty clear here. Gold is for war, or at least for chaos and uncertainty.
And what to avoid.
In this environment, investors must avoid long-dated bonds, particularly government bonds. With inflation likely staying higher and yields potentially rising further, they could suffer significant losses in real terms.
So the traditional 60-40 portfolio might struggle.
Very likely, yes. Ultimately, gold and silver alongside other tangible hard assets that are in limited supply.
Like what?
Things like platinum, oil itself, base metals, agricultural commodities. These, not government bonds, will likely serve as the true anti-fragile risk management tools.
Anti-fragile meaning they benefit from chaos.
Or at least withstand it much better than traditional financial assets as the economy transitions from an inflationary boom potentially into an inflationary bust. They are the assets that tend to stand up well to chaos.
Wow. Okay, quite a journey there. We've uncovered the real state of the labor market behind the headlines, the stark reality of consumer spending once you adjust for inflation.
Yeah, the nominal versus real distinction is key.
The enduring inflation pressures and how all of this really impacts the Fed's decisions or maybe their lack of options, and most critically, how it impacts your portfolio.
It's a lot to process, for sure.
It is, but understanding these interconnected pieces, it feels incredibly important for any investor trying to navigate right now.
Absolutely. And reinforcing that core message, understanding these potential shifts from this inflationary boom to maybe a bust phase. It's just about accumulating knowledge like trivia.
Right, it's about action.
It's about strategic preparation and, frankly, agile adaptation.
Yeah.
The world is clearly changing, the macro environment is shifting, and your investment approach absolutely needs to change with it. You can't just rely on what worked in the last decade.
So lots to think about. And maybe a final provocative thought for everyone listening, building on that last point. Given the complex economic signals we've discussed today and those really powerful historical warnings from the data, what's your anti-fragile asset?
Good question.
What asset will you trust when or if chaos reigns? And maybe confidence in some traditional institutions continues to wane, something to definitely mull over until our next deep dive.